So how do all these global issues impact investors? Let's talk more about that as we continue our special look at investing themes for the fourth quarter. Tonight, we focus on commodities and also the outlook for bonds. Joining us now, Meg McClellan. She is Global Head of Fixed Income Strategy at J.P. Morgan Asset Management. Meg, thanks for joining us. Let me start off with just asking you, what is your outlook for bonds and for U.S. Treasuries, and where do you see the yield on the 10-year by the end of the quarter, by the end of the year?
We believe through the end of the year that you're going to see interest rates very range-bound, and there's a number of reasons for that. Well, fundamentally, growth and wage inflation are picking up in the United States, which would argue for higher interest rates. You have a lot of geopolitical uncertainty out there. So think about the protests in Hong Kong, a potential slowdown in Chinese growth, and certainly we're going to be watching closely the labor market numbers tomorrow that will keep that potential rise in check. There's also a lot of foreign buying from countries in Europe, also in Asia, that are looking at the higher yields in the U.S. and thinking they look relatively cheap to a 90 basis point German 10-year yield. So that's going to help us keep a lid on interest rates. So our view is probably a 50 basis point range or so, say 2.50 to 3% heading into year end, given the balance between fundamentals having a good story and technicals actually driving those interest rates down.
So it sounds like you don't see, Meg, a lot of risk in owning bonds, at least treasuries right now, because some of that foreign money, I was going to ask you where the money's coming from, and you just answered it. A lot of it's coming from Europe.
A lot of it's coming from Europe. A lot of it's coming from Asia. Also, a lot of it, is insurance companies and pension funds here domestically that have to do asset liability matching. They need to buy fixed income. They need to buy higher quality fixed income. And because of the Federal Reserve Purchase Program, they've been competing with the Fed for those assets. So that's also helped keep rates low.
All right, let's bring Tim Gramatovich, Chief Investment Officer at Paratus Asset Management, into this conversation. Tim, let me ask you about oil prices, because you pretty much cover commodities. They've been coming down a lot recently, and so have gasoline prices. What is your outlook on oil prices, and where do you think they'll be by the end of this quarter?
Well, Susie, I think that there's obviously a short term and a long term. I think commodities in general over the last, certainly the last few months have really taken it on the chin. And two of the three factors really relate to sort of commonality. One being a much higher U.S. dollar. The dollar's obviously gone parabolic here in the last, month, bringing down the prices of all commodities. The second factor, Meg had touched upon it, in terms of just global economic weakness in general, right? I mean, you've got really recessionary conditions in Europe, very poor conditions in Japan, and China slowing. So that's those are the particulars in general. With oil, I think that you're really putting at a bottom here. You have a couple of issues that are going on. One, obviously, you have seasonality in the oil business, meaning that refineries take turnarounds. There's obviously a slowdown in demand, as mentioned before, the dollar. But I think what people are missing, and I think it's a massive opportunity for investors, is that production heading into 2015 is not going to be anywhere near as robust as people believe it is. I think the delusion that everybody is suffering, that somehow that because we're drilling out 3 zones in the U.S. that everything is hunky-dory. It isn't. If you look at the globe, and Tyler and you guys cover this well. You look at Libya, you look at Iraq, you look at Venezuela, and now the information coming in from Russia based on sanctions, et cetera. This is all going to kind of play through in 2015, and we're looking for a very, very big bounce in oil.
So I hear you saying to consumers, enjoy these low oil prices while you can, because they won't last. Let me get your very quick thought on 2 other categories of commodities. One would be the metals. I assume you're going to say that that's an economically driven issue. And the other are the agricultural commodities, wheat, corn, and so forth, whose prices have come way down.
Right. Tyler, I think that the issue is on your first point. 100% right. Again, it is a nice offset right now for U.S. consumers in terms of gasoline prices. I'm not a believer that they're going to hold down at these levels. Turning attention to the metals, obviously the metal that everybody's obviously interested in is gold. Gold is interesting. I mean, it stopped going down. I mean, it certainly hasn't done anything. I mean, it's in that low 1,200 area. And we've done a little bit of work, and we're primarily putting on our themes with debt. And so one of the reasons that we like gold, in particular gold bonds, is that all-in sustaining costs for gold across the globe is around $1,250. So you're below that at this point, which simply means that your capacity additions stop. companies start building cash instead of building out mines and production, shrink it. So I think gold is interesting. But Tyler, I'll tell you one other thing that I think gold is interesting because of, and that is that all of this activity that the globe has been engaged with in terms of, whether it was QEs, call it government manipulation, if you will. At the end of the day, has it worked, right?
Okay.
I mean, it's done some good, yes, but I think people will grow tired of paper currency and they will come back to gold.
All right, Tim, we're going to have to leave it there. Interesting stuff, though. Thank you so much, Tim and Meg. Meg McClellan at JP Morgan Asset Management and Tim Gramatovich from Peritus Asset Management.